Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. Super excited for this episode 106. Joining me is Fabio. Please go ahead and give yourself an introduction.
Dave, thank you so much for having me. This is so amazing. Listening to all the episodes, etc. It's just a pleasure and honor to be here. I'm Fabio. You can find me usually on Twitter, fmarciano. We were joking before this started that I'm a recovering growth investor turned dividend investor turned growth investor turned index fund investor. I basically love money and investing and building wealth. So we'll get into that shortly. But I basically have discovered dividends in 2020. And that's where I started. And we can get into how and why I'm, the start of it. But I've been investing since I was 19, and this year I turned 50. So,
oh, wow.
It's been quite a long journey for me. So I'm just anxious and excited to share what I've learned, the mistakes, as well as the successes and kind of the things I've learned along the way with your audience.
1973.
Yeah. Yes.
I'm also 1973, and I got to say, neither one of us look 50 years old.
That's it. Yeah, there's lots of tricks to the trade of looking great. There's no filters on, but there's certain things you can do.
Yeah, for sure, right? Wow. So that seems kind of late to the game, and I'm a little bit late to the game also. 2020, getting into the dividend investing strategy, and I definitely get it, right? Like you just see the you see those dividends starting to come in, whether it's on monthly or quarterly or however often. But nothing to say against total growth investing either, because hey, there's a lot to be said there as well. So
absolutely,
I guess what was your inner argument there between total growth versus dividend investing? And keep in mind that those dividends are part of that total return as well, right?
Absolutely, absolutely. And like as you said, I'm a total return guy. So and we'll get into it later, but I wrote a book, Dividend Millionaire, and I talk about dividend rockets. I talk about people who, and the big takeaway for your audience, one of them would be, can you beat the Bogle line? And the Bogle line is basically an index fund that also has a dividend yield, call it 1.8%, 2%, et cetera. If you can't beat the total return of a standard index fund, SPY, VOO, whatever you want to index it against, the S&P 500 or the total stock market, you got to question what you're doing. Now, if you're retired or you want to live off the income from your dividends, slightly different. Okay, I understand people are not so concerned with total return. They want that cash flow every single month coming in, and they're dialing it in. I see it on Twitter. I see it on other platforms, etc. But for me, I started my career really in growth stocks. And to be honest, I lost it all in the dot-com bust because I was starting my investing career way back when. And it was
the 90s
era of pets.com, et cetera. And you could throw $1 in the market and you had two the next day. So after that, I learned the basics of Warren Buffett and Peter Lynch, investing and analyzing stocks and things of that nature. And that's what I did. I did that for a long, long time. And then the reason why I was late to the game in 2020, I found myself out of work. COVID hit and my company had layoffs. I like to say I was last in, first out, to use an accounting term, as a director. And I realized, okay, yes, stimulus checks and things are coming my way, but I don't have a passive income stream. I never did real estate investing. I felt I was too young to kind of start taking my retirement money. Got kids young. I'm saving for college, etc. So I started looking into dividend stocks and funds and trying to find how can I replace my income? Like, what is this whole big thing about dividends? And then that's where I went into like the rabbit hole that is DivTwit on Twitter. All the crazy characters and amazing characters, people like you who I discovered and really learned from. And then I reached out to mentors of mine and really did a deep dive, read way too many books on dividend investing because I had the free time to come up with a strategy that fit me and my persona, as you said, that likes total return as well as that passive income.
Yeah, wow, that's kind of an amazing. obviously you and I can really relate, being the same age, and being able to relate to back to, the 90s and the late 90s and that dot-com bubble. And like you said, it seemed like you could put money into anything and you were just going to make money until that bubble burst. Right. And
Absolutely.
right. And so I totally get that strategy over the course of your lifetime of just focusing on the total return, and total return. And then, yeah, wow, 2020 came along, and this little thing called COVID hit the entire world. And we were like, whoa, whoa, what just happened here? And I'm sure you weren't the only one. In fact, we all know you weren't the only one who was like, I got to figure out another way to make money, to do something, whether it's passive income or a side hustle or something, because obviously all of a sudden I can't go to work any longer. I personally, I was one of the lucky ones. I was always considered an essential worker, so I really never missed a day of work through the entire pandemic. But I definitely get and feel for people who were in that position where they suddenly realized, hey, what was called a stimulus check in the U.S. and what we called CERB here in Canada, which was called it was invented because of COVID. Canada Emergency Response Benefit, CERB, and it was like great that you had a little bit of help, but you still like, where's the rest of my money? Right?
Exactly. Yeah, and that's it. Like looking just to go, okay, between now and X years from now, how do I set it up? I did love the idea of the free money, etc. I had dividends trickling in from some of my stocks that I had previously invested in, almost like, oh wow, okay, these dividends are coming, but you
never paid attention to them because they were just like, here's a little bit of money here and there and whatever, right?
Yeah, and then all of a sudden you're like, wow, my yield on cost is amazing. Like you don't realize, like even if you buy a growth stock and it's like the dividend yield might be sub 2%, as quoted, but you bought it years ago and now your yield on cost is 10, 20, 30%. And it's just an amazing thing to see all those new shares being repurchased for free, especially if it's in a tax deferred, sheltered type account. Free money, and you either pay or don't pay, like a Roth in the U.S., IRA, etc. So that's where it started. How do you replace that income? And I know that a lot of people probably listening want to do that, and it's not difficult to start. You can start with individual stocks. You can start with ETFs, and again,
shares.
Yeah, like something like an index fund or something like that. I know in Canada, fantastic bank stocks that people love to invest in as well. That's a great strategy. I know you talked to Dividend John, a while back. I interviewed him for my book, and he's one of the guys. Like I'm like, all right, that might not be for me. Obviously, I got to pay foreign taxes on that if I were to do it. But again, that's the beauty of dividend investing. You can do it in
though, because all of those Canadian banks are traded on the New York Stock Exchange in US dollars. So
true. But I think I'd have to look into it. I just know that more of the usual tickers and symbols that I've seen and invested in. There's a foreign tax paid, but I can look into it later.
I do have to just quickly there, about 30 to 60 seconds ago, you said free money, like as if dividends were free money. You are going to get in trouble for that.
I know. I love when people say, oh, no, it's actually earnings that it's like taxed twice. That's money that could be reinvested in the business and earn a lot more money, et cetera, and growth, et cetera. But I also said I'm a total return investor too. So the companies that are giving me my free money, because I didn't do anything for it, they're giving me money. I'm just taking it and getting it and reinvesting it back into the business. I understand. I'm a Warren Buffett, fan, or maybe whatever you want to call it, fanboy. And I know he doesn't pay dividends, but he gladly takes them from all those companies that he's invested in. And, his dividend checks are ridiculous for Berkshire. So it's kind of like one of those, you're talking out of two sides of your mouth. So I'll talk the total return thing and I'll talk the free money thing. I don't care. And it gets back to also the people who invest in like high yield stocks and REITs and things of that nature might not have the total return, but it's the income. You got to do what's right for you.
Yeah.
You should also educate yourself to understand what the trade-offs are and things of your particular strategy and be comfortable with it. So when I see some folks that are, they might have a small portfolio, but they have a huge dividend income annually that they're patty, and they love talking about that and replacing their income, etc. Great. Me particularly, I'm not at that stage where I'm pulling that cash out. I'm going to be doing whatever percentage, some dividend income, some pulling and selling the assets from my account. So I'm agnostic. I'm like looking for something that's going to give me the most money, the most sleep well at night type portfolio. And that's what I've been constructing for myself.
That's awesome. You were the first person to ever refer to yourself as an agnostic investor. 106 guests later, actually 107, because I had Lanny and Bert from Dividend Diplomats on at the same time. So you're actually, it's 107 guests, but plus a few live streams. So you were definitely the first to ever refer to yourself as an agnostic investor.
You know why? Because like people just it's like an identity thing. Like they get so rooted in a certain way. And if someone says something, because I've seen it, like, and it's like, even, I don't follow everybody, and it's like there's so much chatter. I know Dividend John has gotten into like these flame wars and responding back, like the
banks. I love reading those. Some of those are awesome.
It's amazing. I see you jumping in there too, and etc. And it's
honestly, I have jumped in a couple times in the past, and I try not to. To be honest, I try to stay on the sidelines.
I don't jump in. I don't jump in. Again, it's to each his own. And that's why I say I'm agnostic. I'm like, I just get paid. I might have a put and a take on something. Someone might say, hey, it's good to have a paid off home. Someone would be like, you'd be stupid to do that. And it's like, that's why it's personal finance. It's individual. And so for me, I do what I'm doing. I do benchmark myself versus the S&P 500 and then the NASDAQ as well. But I don't do it just over a year to date or a year. I've been doing this for so long. I do it for the life of my account. I look at the 10, the 5, the 3, the 1. I might underperform given some of the growth stocks that I own for a short period. I might outperform. I'm coming out ahead 10 years plus. I like that. And that means like, okay, my active type of investing style works for me. Might not work for everybody. And so again, what works for you? Is it I want to choose at like 6 Canadian bank stocks and that's all my money is going to be in there. I'm comfortable with that. Cool. You want to do these like weird, like fund of funds and stuff that are like 10% yields and things like that. You're comfortable with that. Cool. Just know the downside. That's all. Educate yourself. Don't go just off someone on Twitter or Instagram, like talking about this stock is awesome and you should do this, or look at me, I just bought income at a 50% yield. Okay, great. So that the lesson is to do your homework.
For sure. And and myself, and I'm sure the majority of my audience, definitely knows the argument on both sides of that total growth versus dividend. If a company's not paying dividends, then they could be paying down debt. They could be doing R&D to help further develop the company. They could be using that money for literally a plethora of other things.
Yeah, like six things. I forget all of them.
And so, the argument for a non-dividend paying company that is growing and you're getting that total growth, hey, that's great. And like you said, that's a personal choice. That's up to the individual, and that's why you have to do your own research and do your own due diligence and figure out what works for you. And I mean, like, people know I love my dividends, right?
Absolutely.
So, and it sounds like you really enjoy those dividends rolling in as well. And you get to see that money grow monthly and quarterly. You get to reinvest those dividends, and I agree 110% with everything you just said there about sort of the personal choices and figure out what works for you and what you're comfortable with, right? Like exactly what you said. It's personal finance because it's personal.
Exactly.
I do have to ask you though, because you've kind of mentioned, we've kind of like, so first I'm curious, how many total like positions do you have? Total stocks plus ETFs, index funds? Like, are you like a 10 or a 20 or a 30 type of person?
unfortunately, I recommend people look at in the 20 range, but then I'm like the hypocrite. I'm probably in the 30 to 33 range, 34, something like that. But it's highly concentrated. I mean, the top 5 or 6 are making up the bulk of my assets.
Right.
And where I don't share like specific ticker symbols and things of that nature. I've started moving a little bit more towards index funds and things of that nature. It's the sleep well at night type thing. So I don't have to worry about like, oh, is Tesla going to make earnings or not? Or is Apple, not the next iPhone 68 is a dud. And now you're worrying about that. But for most people, especially when you're starting out, a good index fund, or, if you want to try dividend ETFs, et cetera, and then a couple of stock picks, you're going to be fine because you're starting small, and then you could build out and then do your research. The main thing for people is not to overthink it when they're starting. It's just start. So for me, back in the
Get
day,
on base. Just
that's
get
all
on
it is.
base.
That's all it is for
Get
me.
hit by a pitch, whatever it takes. Just get on base.
Here's $100. Here's $50. And nowadays, we joked about our age, and when we started, it's like the cost to buy stocks back then was crazy, and so like I was paying $30 a transaction, and it really began to eat in. And I was a guy like was broke when I was 25. I had a negative net worth at 25. And so I was starting to invest. I was investing $100 into mutual fund. I didn't even know what I was doing. I was paying a loaded fee because I worked.
And they're done that.
Yeah, and then I chased growth stocks funds because you'd look in Money Magazine, you'd get it, and you'd see, oh, okay, this was the hot, mutual fund last year, and then you realize, okay, it's like one of these things. Whoever's hot this year is not the next, and then you can do it. I'm going to invest in this category of assets. I'm going to invest in REITs, or I'm going to invest in consumer goods, and then the next year it's down. So that's where my mindset, but it took a number of years in reading and understanding and looking at the history of this stuff and some of the cool graphs and things that you can just look at and go, oh, okay. Let me go find those economic moats and durable, brands and things of that nature. And I'm a marketing and finance guy. It's like, no duh, find companies that are going to be around for the next 20, 30 years, invest in them,
100 years, right? Like the Coca-Cola, the McDonald's, the Costco's, the Walmarts.
Absolutely. And again, even for those stocks and different stocks, people say, okay, these are the ones. And like, I'll see people posting, oh, I love this stock. I love this stuff. I always say, like, how is it doing versus the S&P 500? Most people don't look at that. They'll look at, okay, what's my dividend yields or what's my dividend income, et cetera. But I'm like, again, total return. So I always just quickly, I'll just go online. I think it's investingchannel.com. I'll punch in SPY versus the ticker symbol for whatever amount of time of years. And I'm like, did it actually beat the market? And then if it didn't, okay, what's the dividend growth rate? And then, there's like 20 different variables of analyzing a stock. If you want to get it like into nerd mode, you can. And I've done that, and it's just like, I just like to make sure that if I'm going to invest in something new, that it probably has a great potential to beat the market.
Yeah, that's very interesting that, you compare stocks directly to the S&P 500, and, if it outperforms over whatever your time span is, 5, 10, 15 years, that's incredible. And do you have a cutoff? Like, hey, this one was close. This one was really close.
I do. Again, there's so many variables. Like I sit there, I'll look at the business. I'll look at the dividend growth rate. I'll look at the just the company analysis. Like, does it have a moat? What's the brand? Are there new products? Is there a reason to believe? So a company like Microsoft, people were making fun of for a number of years. Then all of a sudden, they start to hit their stride under their new CEO, and things take off. Dividend growth rate, chugging along, et cetera. And it's like, wow, okay, this thing, they're doing well.
Yeah.
Or even Apple when Buffett bought in, some of that, like, you're like, okay, well, how's this doing? Does it have a chance to continue to outperform? But I look at PE ratio. I look at PEG ratio. I look at free cash flow. I want to see the fundamentals are there. And again, it's not super difficult. I just go to Seeking Alpha. I have a watch list. I download the data, and it just spits out the analysis for me. and like there's a lot of websites you could just do and do that analysis. But again, I just like to see if it's close enough. Like, something could be if the market's up 10% for the past 10 years and this stock is up 10%, and then for 5 years it's close enough, but the dividend yield is higher and the total return, is that much higher or close. I'm like, you know what? I'll take a chance on that.
I'm going to quickly say a couple points here. One, you got to go back to about episode 40, 41, somewhere in the 40s, 41, 42-ish. Master P, also around our age, who we talked a lot about trading stocks in the 90s and what he was doing, like driving around with a roll of quarters to find a payphone with his 16-digit PIN written down on a little scrap piece of paper in his wallet so he could call a stockbroker. So definitely recommend checking out. Go back and find episode 40 or 41, 42-ish, maybe. Yeah, so that was a really good one. With that said, I'm just going to I want to kind of mention or what you just said, Microsoft and Apple. So I guess first, Microsoft, it's used in every office in the world, right? Excel, Word, PowerPoint, Outlook. It's sort of that bundle of like every office in the world is using Microsoft Office, basically, right? And most people at home, or a lot of people at home, are using Microsoft Office as well. And so that's not going away anytime soon. So I definitely see the bullish argument for Microsoft. Apple. So I'm not an Apple person. I have my laptop is not Apple. My phone is an Android. I've had Apple phones in iPhones in the past. Not a fan. Their batteries don't survive the cold Canadian winters. But my point with Apple, pretty much their driving force is the iPhone. I know they have tons of other great products as well. And what I've said this so many times, you can probably go back and find me saying this 20 or 30 times on different episodes of the Passive Income podcast, where in, let's say, around 2006, 7, 8, BlackBerry was by far and away the number one phone, right? And so is there something going to come along that's going to displace iPhone as the number one phone?
You never know. I mean, listen, Dave, the one thing is, so I pulled it up on my other screen. For those that are watching on YouTube, I have like a screen. This is the screener I do it manually because I'm a spreadsheet idiot or nerd versus like some of these apps. But like Microsoft, the yield is about 0.82, right? So that would be like, that's not a dividend stock, etc. Right. But then you look at like their growth rate, 3 years, 10%. Growth rate, 5 years, also about 10%. So you're talking like some solid dividend growth. And the reason why it's so low, the yield, is because the price has appreciated so much because it's done so well. Right. And that's the thing that, I call them a dividend rocket, where the dividend yield might be low, but the dividend growth rate is high. And so it gets lost in kind of the screeners and the analysis. Now the PE ratio,
lost in translation.
That's exactly it. It's just overlooked. The PE might be high. And then if I just, scroll over and I say, okay, 5-year total return, 225% versus 68% versus the S&P, 1,180% versus 222. So you're getting dividends and you're getting that price appreciation and that returns. And I could do it for Apple. I've got probably 100 different stock tickers here that I just look at. And I'll do this. I haven't done the analysis in a while because I'm pretty happy with the picks I have. But whenever someone comes up with a new idea or something, or I see something that a lot of people are talking about, I'll throw it into my Seeking Alpha, portfolio. I'll download this. I'll do a quick analysis. And then I could just see, okay, yeah, like the free cash flow on Microsoft, 11%. Okay, not bad. Net income, pretty solid, and all that. You're doing the basic analysis of the business. And that's how you should do it. Not just based on a dividend yield or just a price valuation, because maybe 30 PE is okay. What's the PEG ratio? What's the free cash flow? So it's just doing those a little bit extra, and it's not that hard to learn. And again, if you look at it as your investing career, like you have many years, you have decades to go. You might as well invest in the knowledge and learn this stuff and kind of do that deep dive versus just the surface level that a lot of people and a lot of investors do. It's like, oh yeah, I'm investing in the market and stuff, and they don't really understand, you know, price valuation and all this other stuff. You don't need to know like the nitty gritty, but be knowledgeable enough to know the difference between, okay, something might have a low dividend yield is because price appreciation. Just simple things like that
Right.
might 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 get them to have a winner in their portfolio that they might have overlooked if they were just going by certain metrics.
Yeah. I absolutely love that term, dividend rockets.
Yeah.
I'm gonna definitely adopt that.
Well, it's just one of those things. Like I realized it again. It was like Apple was the thing that hit me in the head, with Buffett and things of that nature. They talk about Coca-Cola. He bought it all those years ago, and it's his yield on cost. That
Right.
might not have been a dividend rocket by the term, but again, a dividend rocket, all it is something that has a low yield but high growth in dividends, and it's price appreciation. And so in my book, Dividend Millionaire, I go through various different ways of like analyzing stocks. Like one is a cigarette butt. It's got low dividend growth, but a high yield. So something like actually Philip Morris or some of those stocks that they're eking out their dividend. It's like, oh, okay, we want to stay on it. We want to be a dividend aristocrat or a king. We want to stay on that list. So here's a penny, guys. And
Yeah.
so they don't really raise the dividend growth a lot, but they have a high yield. So I call them a cigarette butt. And that's kind of a hat tip to like Benjamin Graham and Buffett back in the day when they were investing in actual cigarette butts that were probably had a lot of assets on the balance sheet, but they were low priced. You know,
Yeah.
so it's just looking at that like a matrix of just trying to think about it a little bit differently.
Interesting. Since we're talking about dividend yield and dividend growth and total growth, I've seen a lot lately on Twitter or X, the app formerly known as Twitter.
Yeah.
And honestly, I know nothing about this company or ticker symbol, but it's ticker symbol TSLY.
Oh,
What's going on there? Do you know anything
I
about
don't.
this?
Yeah, I think I briefly looked into it. I don't know a ton of it about it, to be honest. It's one of those things where if a lot of people are looking at something like that and they're just like all over it, it's like a big red flag for me. So I'll
Meme
punch it in
stocks,
right here.
AMC, Game Boy, or GameStop, and the others.
Yeah. So, oh, you said TSLY, right?
Yeah,
Yeah.
because
Oops,
it's something has
it's
something
not
like a
coming up. Oh,
46% yield. Is that right?
yeah, yield max Tesla option income. So again, it's one of those things where they're buying options or selling options. I don't know that, again, I'm the moron. Put it in the comments, guys. I don't know much about this, but
Again,
like
this is
this,
not financial advice. We are just two people having a conversation.
yeah, expense ratio 1%, yield of 46%. Again, I can guess they're just selling options like QYLD and some of those that are probably selling options on Tesla, and
Right.
that's what they're doing. And yes, you might love taking home that 46%, but it looks like it was at a high of 21.76 on December 2nd, and it's at $14. So $21 to 14. So you lost money on the price if you bought and were to sell. You got all those dividends coming in. But again, are the dividends equal or have they cut them and up and down? I don't know.
I don't know
Like
that either.
that's the thing for me. And by the way, it's less than 5 years old. It's like a year and a half.
Oh, so there's
So
no
it's
history
like
to it.
Zim and some of those others that you like flash moments. So you might play it, and maybe you play it. It's just like, okay, I'm gonna be that guy like GameStop, AMC. I'm gonna make my bag. I'm gonna sell to some other sucker.
Right.
I don't know. To me, I don't know here. This is the type of thing where it's the shiny object. It's the .com stocks back in the day. It's like people learning how to sell options for the first time or do cover calls or, I'm going to do a play. Look at my options play because that's the hot thing. Let me do
Yeah.
crypto. Let me do NFTs. And then all of a sudden they're the sucker holding, the short end of the stick versus going, you know what? Coca-Cola ain't going nowhere. Pepsi's going to be here. Apple's pretty solid. Microsoft's pretty good. Even
Yeah.
if you
Home
wanted to,
Depot, Lowe's, like the
Home
list of
Depot,
American companies just goes on and on and on, right?
stocks, like they're going to be, those have their own challenges, but it's not a trend or a flavor of the month. And so that's the thing people just need to be worried about. If they want to play around, and with this, I always say I had a Vegas fund. So I had some cash set aside and I just was the risky growth stocks. Some paid off, some didn't. All it takes is one stock. I was
Yeah.
just listening to a podcast earlier today. The guy was like $8.3 million net worth, 55 years old. He's going through his story and he's like, back in 2019, 2020, I played options, Tesla, and some other stock. I couldn't hear it because it was raining so hard. He made $1 million one day. He made $1 million the next day. He lost 700 the next day, but he net was up and he retired early. I follow a guy, Jason DeBolt, $12, $13 million in Tesla stock. That can happen, but it's probably not going to happen to you. So you better learn how to just do it right versus going, I'm going all in on Tesla. Woohoo! You might be the one that's like buying at the high and selling low. So it's a cautionary tale. That doesn't mean you can't put a couple of percentage of points of your money into that Vegas fund and roll the dice and you hit it big. You might actually get rich quick.
Yeah.
But the odds are not in your favor. And that's like people play options, 80 to 90% lose money. The only ones that are making money are either the ones that are the outliers or the ones selling courses about how they sell options.
Right.
Or Forex or crypto or NFTs. Yeah. And that's why I love.
And if you're selling a course, that means you're probably actually not making money because you're making money selling the course.
That's it. The joke is the real estate gurus made more money selling no money down real estate, things versus their real estate. Now, whether that's true or not in particular cases, or here's my flipping houses course, and stuff. So it's just be like, it's called the paradox of practice. The way I'm telling you to make money is different than the way I actually made my money. Yeah. So I'm not like that. I fully own. I'm a growth stock guy, shifted to index funds, and portion of my assets are in dividend stocks, taxable account, and retirement accounts as well. I'm not accessing that money. I'm reinvesting it. I'm paying the taxes on the taxable brokerage out of pocket. Mainly, I just want to set it up. I get to a certain number, I'm going to feel really cool going to bed at night.
So just out of curiosity, do you ever, or have you ever done any of those types of things like options tradings, swing trades, day trades?
I learned about options 2021. Started playing around. Day trading, I'll take a step back. Day trading was like the first thing I did, like 98, 97. Is that my job?
Was impossible to do back then because we barely had the internet. We didn't have online banking. We didn't have, brokerage platforms.
It was 99, 2000. I remember because my boss snuck up behind me and goes, "What are you doing?" And I actually had to close the screen. I alt tab to another screen. I'm like, "Oh my God." I was on my Fidelity account day trading basically, and I was doing well. Obviously, it was before the .com burst. And then I realized, okay, I'm a long haul guy, etc. And then I learned a little bit about options, started getting into like leaps and buying options for stocks that mostly I believed in, and then some I just didn't know. It was like Twitter, and they were talking about like this stock and this stock, etc. It was the bubble, like Upstart and like all of those other stocks and stuff like that. I made a killing on paper. And then it just tanked, like, November 21.
And then you went broke on paper.
Yeah, then you're giving up a lot of the gains. I mean, I booked a lot of them and stuff, and it was in a retirement account mostly. I had a nice, wonderful tax bill to pay, from some of the games in the taxable. But again, options, I'm not making fun of it. I think covered calls, like if you own stocks and you get paid to wait, paid to wait via buying puts or selling puts, there's some cool ways to make some money with options. And to be honest, I did about 6-7 months. I made about 60 grand doing it, 58K. Oh, wow. I think it was. Yeah, it was cool. And I was doing it. And then I got burned on one stock. And I was just so pissed off. It was April 2022. I remember it. And I stopped. I accidentally sold. I forget what I did, but it was earnings day and their earnings sucked. It was Netflix, tanked. I was holding the bag, and I realized, you know what? This is annoying. I'm like at work trying to do it on my lunch break, selling, because I was like, oh, I want to be like one of these guys. I'm making 5-10K a month, selling options. And then you quickly realize, okay, my portfolio is just chugging along. I'm pretty good. I think once I retire, I'll do the options thing when I have a little bit more time and bandwidth. But now with work and kids and like
Yeah.
all my other stuff, I just can't mentally do that again.
Okay,
But
I
yeah,
know we weren't. I know we said we weren't going to do stock picks, and I don't want to call this a stock pick, but you said you had about 30, 35-ish in your portfolio, and you said it was highly concentrated to those top five. So just curious, what are those top five or even top three? And again, this is not a stock pick. This is just your personal preference.
Yeah, I'll throw out some names and stuff like that, and I'll just scroll through and just say some names. SPY, S&P 500 index fund. It's across a number of things. It's the easiest thing to do. Apple. I own Apple. It's one of those things that, again, when you talk about yield on cost, my mentor, he's like just awakened. He's like, hey, I'm a dividend investor. It's like, and also price appreciation. And you're like, wow. One of the dogs that I do own that's in my portfolio and I hold on to it, it's still at a loss, is Ally Bank. I just believe in the power of it, and it has a pretty sweet yield, but it hasn't performed as well. You got a lot of things going on, yielding about 4.3% right now. I've held Amazon for years. That's not necessarily dividend, et cetera. Tesla. I own a little TQQQ if you want a little bit of a leverage, NASDAQ index fund, et cetera. That'll go up and down with my personal feeling about the market and how things are going. NVIDIA, things of that nature. I like brands that have kind of like an economic moat, that have the ability of pricing power, or that they're like the kings of the kings. Speculative play like Celsius Energy. I actually love that product. And it's not a dividend stock. It's, Pepsi's bought a bunch of it, and I just feel like it's the next monster, type thing. So I throw some money in there. Got burned on Rocket Mortgage. I just think, again, I'm going for like folks that are going to disrupt categories, in the little bleeding edge, and then just throwing some money and seeing what happens there. But like those are just some, I get like, again, I'm staring at this list on the other screen of like all these other things that I look at and own, and I own pieces of them, but I've shifted more and more money a little bit to the index funds, et cetera. They might only give me 1.4, 1.8% yield, et cetera, but I'm not going to, lose sleep because I'm at the market. You can juice it with a little bit of these other exotic plays. Like I know SCHD, everybody talks about like, oh, that
I was just going to ask you about SCHD because you haven't brought it up yet, and it's obvious it's a fan favorite on X, the app formerly known as Twitter, and
yeah, and I listen. It's got a nice fat yield, 3.54 versus 1.47. Dividend growth, 12.3 for 3 years, 13.9. Let's just kick it over to performance. I think the last time I looked at it, I just ran the numbers, and I was just like, guys, what are you doing here? So 3-year total return, 42% versus 35 for SP. That sounds amazing. 1-year performance, 1% versus 12 for the S&P 500. You look at 5-year total return, 64% versus 68, and then 10-year return, 201 versus 222. So
those
total
sound like pretty good numbers overall.
It's good, but I just feel like when anything's actively managed and you're trying to play the game, there's room for error. And I know X% of actively managed underperforming, straight up index fund over the years. So you can do it in a year or 3 or 5, but generally over 10 to 20 years. So that's why I don't prefer a fund like that. That's my personal take. This is not financial advice. I just feel like it's reversion to the mean. Eventually these pickers or algorithms or whatever are going to get it wrong. So if they're going to overweight in an NVIDIA or a Philip Morris or et cetera, that eventually something's going to hit in a negative way, and it's going to be a reversion to the mean. So I just quoted some numbers, and guess what? A couple percent either way, there goes all your gains, in a particular time period. Now, if you want that 3% yield plus, and you're going to do, keep investing and it gets up to 4, 5, 6, 7, 8, 10% yield on cost, awesome. Right. You choose to do that. I have a small, like a couple of shares of it just to compare it, when I started dividend investing. My other picks are doing better. So like, I call it a bias, call it whatever you will.
I think you just made an extremely important point there about yield on cost, where if you hold it long enough, you dollar cost average in long enough, and then your yield on cost is to the point where it's like, hey, you're doing great either way.
Yeah, the yield on cost, it's just like it's an eye opener, especially with like Dividend Rockets and things like that, where it's like, oh, it's 0.84%. Like, yeah, I bought it a decade ago, and now it's 10% for me, and so I'm getting paid, nice dividend, and the price appreciation has been above the market. So again, it's just bringing awareness to a couple of things like that. Good, an investment might have been good at a moment in time, like for someone, but 5 years later, 10 years later, it's not. And so that's why it's like, I did an analysis once that I put it on Twitter, because this person was like, oh, SCHD and, Schwab, this like the high growth. And then I'm like, let me just compare it if you did it 10 years ago versus SPY, and it didn't pan out. I'm like, this sucks. And the guy was like, I think it was a guy. He's like, oh, you just chose your time frame. I'm like, choose your time frame. I'll just plug it into invest. Oh my God, Investor Channel. I think it's Investor Channel, and it'll spit it out. And again, it just depends. When did you put in all these calculators? It's like 10K. It's like it's a moment in time. You put 10K. Nobody does that. It's $100, $200, $50 a month
for the most part. Yeah, most of us are just every paycheck, every second Thursday or Friday, you're putting in that, like you said, 200, 300, whatever dollars it is, right?
It's the old, the memes and the jokes about, yeah, you would have bought Amazon back in 1998 when the thing tanked and stuff. No, you wouldn't. Or, so if your listeners are interested in a book that really brings this to life, it's 100 Baggers by Chris Mayer. It's an amazing book. And he shows like Monster Energy quarter by quarter, and like, how many 50% drawdowns or drops in stock price you would have had to endure to have this wonderful gain. Right. So like everybody's like, oh, Domino's Pizza. Oh my God, what are the other big winners over the decades? But like Domino's is definitely one of them, and Monster Energy, etc. You have to have like an iron will, gut, sleeping well at night, or you just not need that money, because it's like yo-yo. And that was Amazon, like Apple, same thing. So it's just always, what is someone's time period? When did they buy? Why do they love it? Are they irrational? Do they just care about yield? Are they retired? Do they have a spousal income on the side? What's their cost of living? Where do they live? What's their tax rate? Like, there's so many factors. And that's why I kind of like always say, find someone near you that has your similar background, and see what they're doing to succeed in life and copy them. And so for me, I find my mentor, I find all you guys online, and I like Dividend John and you, et cetera, and all these accounts. I'm like, okay, how are they doing it? Yeah. I'm not living in a low cost European or, certain countries where it's like the cost of living or the like the dividend of a couple of bucks, like, is the full day, that's not, I live in a high cost area in New Jersey.
Yeah. So, well, both of us, like Canada and the US, are not cheap countries to live in.
Yeah. So anyway, it's a little side rant of like, just compare yourself to someone like you in your area, do the analysis. Again, the main thing is, if you live below your means and you maximize your income as much as you can, you set aside 10, 15, I used to say 10. If you set aside 15 to 20% of your money invested for the long term, and you do it monthly, you live below your means, you have, you invest in experiences versus stuff, you're going to come out okay. you're probably going to be able to retire early.
Sure, right.
And if you avoid the stupid mistakes like I did, like day trading and like .com investing and some of this stuff, and just do like what Dave is telling you about dividend investing and kind of just like the maybe slower and steadier, you're gonna be able to retire earlier. You're gonna have a great quality of life now. That's the other thing. It's not like frugal. I'm just gonna like penny pinch and like be miserable for 20 years so that I can retire. And it's like, no, like enjoy your life now.
Yeah.
Focus on, and that's why Ramit Sethi talks about conscious spending, and spending a lot of money on the stuff that you really enjoy and cutting back ruthlessly elsewhere. I love that because that's what I do. I try to buy experiences and do things with my family. I only indulge in a couple of things that I love to do, and otherwise I'm just a plain ordinary guy. But I secured my bag by investing and investing in myself, high value assets, skills that I get paid well for, and then just being smart with my money and learning the difference between a get rich scheme and like long-term smart investing that's going to pay off.
I love what you just said there. Be smart with my money. I do want to ask you about one more stock, and then we'll try to wrap it up. But
if it's on the list,
so obviously SEHD is a fan favorite on X, and the other big one, and you mentioned REITs earlier on. So I really just want to get your opinion or thoughts about Realty Income, ticker symbol O. Definitely another fan favorite in the community. And that kind of goes back to another point you made where, hey, we might just be raising our dividend by a few pennies, but but we're raising our dividend. So just a few words on Realty Income.
Yeah, I'm not, full transparency, don't own it. I know a couple of guys that love it. I follow their accounts, etc. I like 25 years of consecutive dividend increases, 3-year 4.07, 5-year 3.71%. Yield is 5.5, forward is 5.57. I mean, that's again a nice fat kind of gain there. Again, REITs are a little bit different with payout ratios.
Yeah, definitely.
You're in the 74 to 80% range, which is okay. I just look at something and it's like, pick a date range. 3-year total return 1.58% versus 36% for the S&P 500. 1.58%, 1.58% versus 36%. 5-year total 22% versus 68, and 128 versus 222 for total 10 years. Again,
so basically what you're saying is the S&P,
unless I did
greatly outperforms.
Hey, that's me. And I get the reason you want that higher yield, but when I see folks talking about this stuff, and it's like OKE is on my symbol, like right below it, not doing that much greater. But again, 3-year performance, rocking it, like trouncing the S&P 500. Again, I think some of these things are like this. In REITs, it's cyclical. It's a little bit like how's the economy doing, the interest rates, et cetera, and stuff. Yeah. So I just look at it that way. This is just one guy's opinion. But me personally, I don't do Patty. I don't look at that. I do look at like what my total dividends are for the year and my yield on calls. Like I do that stuff. But then I just look at total return and I'm like, I just can't invest in things like that. That's my
mindset.
I'm doing it. Because at the end of the day, like you're then comparing yourself to something that, I don't know, you're tricking yourself into investing into something, and that by playing with the metrics. Like for me, it's total return. Like what other method is there? It's like total return includes dividends. And so that's why, again, I'm just using one source unless seeking alpha and FinViz and some of these others that I use. So that's all, and again, please go kindly in the comments when you guys watch this and stuff. But I'm just trying to raise awareness of this just in general. And part of the reason I started and I wrote the book that I wrote and I went into this like rabbit hole of dividend investing is because people were talking about stocks and things and they were saying, oh, look at the dividend aristocrat list or the dividend kings. And I'm like, you're investing in that stock? And in my finance background and like analysis kicked in, I'm like, that they raised it a penny. And it's like they're still on it. And like that's what you want to invest in. Like it's clear that they don't have a path. And like there are people borrowing money to pay dividends, or the payout ratio is skyrocketing. And it's like, do you really want to invest in that business? So like I actually applaud boards when they cut dividends and they're like, this is not sustainable and we got to do this, etc. And the thing that triggered it, like the outrage in my head, was like AT&T stock back in the day. But AT&T 7%, da da da. I'm like, AT&T, that's what you're investing your money in? Like that was just me personally. This is like a personal opinion. And then the whatever that went through, and I don't know all the details. Dividend cut, the merger and like the split and like a new company and this type of thing. But it's like, it's a cutthroat business. Like, what else are you doing to grow the business? And I have a list in front of me. I do a company analysis, a business analysis, a dividend analysis, a price analysis, a trend analysis. Sounds like a lot of work, but guess what? You worked freaking hard for your money. You might as well like do
for you.
I just drew a spreadsheet. I did this because I'm like, oh my God, Dave's going to ask me stuff. And I pulled this thing up and I copy and pasted. It took me 20 minutes. And I could sit there and see just quickly, and you got to educate yourself on some of these numbers, but then you quickly say, well, wow, do I want to put my money there? And that's all you need to do. And if it's too much work for you, great. Index funds are there for you. Low cost. It's great. Canadian bank stocks, if you're in Canada, in the US, pick something that's going to be there for a long time and that, the revenues continue to go up. It's led by competent managers, etc. Like you don't have to do a 20-point analysis, but
no,
you got to do
but with that said, I absolutely love your approach to investing where you're basically looking for the best of both worlds. You want it all. You're like, I want total growth and I want dividend growth, and give it to me now.
I'm a little greedy, to be honest. And again, it's the total. Like I know I'll shift a little bit to dividend growth, and I'll be like some of those folks that I follow that are going to give up a little bit in the total growth, total return for dividends because they want that check. And they want to feel comfortable going, oh, but they've done it for 25 years. They'll continue. So I'm signing up for this. It's almost like an annuity, to throw out a crazy bad word, but like that's what you're signing up for.
Right.
Well, you don't know. If the salesperson is good, you probably think you're getting a great deal, but you're probably going to underperform a standard index fund. But you go to sleep at night knowing I get that check in my bank account every single, the 15th of the month, and I can live off that. And I'm good with that.
Yeah.
Great. I'm not there yet.
And exactly like you, or I guess we're kind of both thinking, at 50 years old, showed it to 1973, 10 years down the line, we're going to be 60 years old. And that's when we really want to probably start thinking about retirement and be like, okay, exactly like you just said, what's coming in every month that I'm not relying on. I believe in the US, you call it Social Security. And then in Canada, we have a few other programs that are basically the same thing, with just paying old people because you've paid taxes your whole life. But I'm sure, I don't know, but I'm guessing in the US, the same as in Canada, that's not enough to live off of. So you definitely need to have more, whether it's passive income or investments of some kind.
Listen,
I do want.
Oh, go ahead.
I was just going to say, I want to bring up your link tree. The link will be in the description. And so,
if folks, the link, you just go to it. There's a free report right there. It's the 9 to 5 multimillionaire. I've been blessed to learn from my mistakes and invest and do well enough to reach certain status money-wise in my life. I do measure wealth a little bit differently than most. It's not just money. There are 5 areas to wealth. And, I talk a lot about that on Twitter. But that's a free report for people. It's the 7 steps that I took to get to where I am in life, financially.
Right.
And then a Dividend Millionaire, I mentioned that a lot. It's just an ebook. It's available on Gumroad. I I poured my heart into that. It talks about dividend rockets. It talks about dividend unicorns and cigarette butts and like cash cows and, you know, dividend dogs and the mistakes people use. The analogy that I came up with for that book, one of the ones is dividend Moneyball. You know, trying to assemble the overlooked players that most dividend investors, some of the stocks that are the sexy picks.
But that's where my get on base, just get on base from the Moneyball. That's I say it all the time. Just get on base, right? And it comes from Moneyball.
I didn't out in case I was wrong, but I'm like he's probably making a reference to it. But yeah, it's like, you know, in the movie, obviously Brad Pitt and Jonah Hill did an amazing job. I love the book, but then it hit home for me about buying almost like mispriced assets, and that's kind of like Warren Buffett and some of these value investors, what they look for. And you try to understand like what really drives, and that's like when I was talking about analyzing the business, etc. Most people are just going to look at dividend yield. They're going to look at like that sexy stat of home runs and things of that nature. We know from Moneyball and that era, and oh my God, Michael Lewis, you know, brought it to life in that book, and then the movie with Brad Pitt, of like the actual stats that matter, like on base percentage and stuff like that, and like walks
just
were
get
more
on
important.
Base. Just get on
Just
base.
get on base, because it better
by a pitch. That's all you got to do.
More good will happen if you're on base versus, you know, swinging for the fences and valuing and buying assets that basically are undervalued. So, you know, and it's like we got to replace Jason Giambi, and it's like, oh, just give me 3 players that could have his on base percentage. So there's fun stuff like that. I promise you can just skip to like ahead to like the analysis, or you can just learn about some of these things. My hope is with this book, it rejiggers people's thinking about dividend investing.
Right.
Turbocharged. This is actually an affiliate product link. That's the book where I finally understood options. I started doing what he said. Just playing conservative. It was I was $10. I made 58 grand out of it. I think it's actually 56. I had a down month, but it was just one of those unlocks for me. Like he laid it out super simple about how to do it. And that's actually his second book, Get Paid to Wait, about puts. You know, basically agreeing to buy a certain stock if it goes below a certain price. I did that as well. I'm not as active in it. I mentioned that earlier. But so those are just some of the books and things and resources. And again, at F Marciano. That's my ugly mug there. And the tagline of Money Ain't Wealth. There's more to life than just finances, friends. So it's family, it's critical. Your faith, your finances are important, but your fitness, and you also have to have fun. So those are the 5 pillars of wealth, according to me.
Yeah. So basically, you can find Fabio on Twitter, on X, the app formerly known as Twitter, at F Marciano. Am I pronouncing that correct?
Yeah, you got it.
And so, yeah, definitely give Fabio a follow over there. Excellent content. Love following you. Yeah.
I appreciate it.
Awesome. So definitely the link will be in the description below for the link tree, so you can find all of that great content there as well. Before we sign off, do you have any final thoughts or words to say in closing?
Yeah, I would say if you haven't started, start.
Just get on base.
Get on base. You don't need to know like everything. You can start with $1. You can start with $5, $10, whatever it is. You can buy a sexy dividend pick or something like that for yield. Just don't put all your money into like one position. And if you find like you don't just have the mental bandwidth for it or time, etc., index funds are a super cheat code for getting really wealthy. The Simple Path to Wealth, J.L. Collins' amazing book, just talks about that. You can buy one index fund and you're going to be okay. And yes, it's only a 1.4% yield. I think when I wrote the book is 1.8%. So that just shows you how much the price appreciation of the S&P has gone up.
Right.
But just get started. Also educate yourself. You know, if someone's recommending something, just learn the basics of just analyzing a stock, if that's what you're going to do. Try to avoid getting burned, because if you don't have a ton of money to invest and, you know, you haven't saved a lot at this point in life, you need that money to go farther for you. and you don't need to get burned by putting all your money into, some guy or gal's pick from Twitter or Instagram or YouTube, or etc. So just know enough. Learn financial literacy is super important. So again, your own personal finances, living below your means, getting out of credit card debt, all of that stuff just makes life so much easier, so much easier. You sleep well at night. And if you do unfortunately get impacted by layoffs and things of that nature, or medical bills, etc., you're in a good financial place where you don't have to make bad decisions because you're forced to. So just take care of your finances, take care of your loved ones. It's not all about money, guys. Like, make sure you invest in yourself, your skills to get paid more, but also make sure you have a lot more fun. Do the fun things.
Yeah.
It's okay to spend a little money here and there, because, you don't want to look back on life and say, I coulda, shoulda, or woulda. Do that stuff now, because the memories of the things that you do are going to be a lot more important than the stuff you bought.
Definitely 110%, right? Like, I'm sure you can relate too. Like, again, being 50 years old, you look back on the last, say, 30, even 40 years of your life, and you have all these incredible memories, but I can't remember a lot of the stuff I ever bought over those years.
No.
But I have tons of great memories, whether it's going to a concert with my buddies when we were teenagers or in our 20s, or a trip somewhere, or whatever it may have been. But experiences are worth so much more than just things and items.
Yeah. And listen, you can, like I always say to people, I buy running sneakers and books and coffee. Like, those are my little, like, indulgences and things like that. All my extra money goes towards my kids and my wife, and like the house and stuff like that, and investing, etc. Like, I don't need much to be happy. And that's, I think, an important thing. No matter how much you make, live below your means.
That's because we're Generation X, man. We were taught to be happy with just
with
be happy with what you have.
Here's the bike. All right, just be home before dark. It's kind of like, just go out there and play, or hand me downs and things of that nature. My parents, solid work ethic and stuff like that, instilled that in me. It's like, I thought I needed the BMW. I needed a bunch of other stuff when I first started working, etc. But you quickly realize, like,
you don't.
No, and I splurge on my kids if we're at the arcade, extra money to go play and win some things and stuff, because that's what they're going to remember.
Yeah.
And I'm investing in experiences and memories for my kids more than anything right now. And I'm okay with that. And part of that is, I've been fortunate enough to, like, have learned the money lessons early enough. And even if you're starting late, you can, like, make up massive ground by just living below your means, investing in your high value skills, switching jobs, getting paid more, things of that nature.
Yeah.
So just know that you can do a lot more than you probably are. And that if you're thinking it and dreaming it, you can do it. You just got to take action. Find someone who has done what you want to do and just copy them. It's that simple.
Yeah. If you think it, you can do it. I do just, you've said it several times now in the last hour, that sleep well at night. And so I just kind of want to end off on that. Do things and invest in companies and stocks, and whether it's ETFs or index funds, that let you sleep well at night. I see we're already well over an hour. Amazing how quickly an hour conversation has passed by. I feel like we could keep talking for another few hours for sure. This has just been incredible. I appreciate you coming on and spending time with me, and spending your time with me. So thank you so much for being a guest here on the Passive Income Podcast. And if you're still watching, if you're still here well over an hour later, please be sure to hit subscribe.